Paul, thank you so much for joining us today. As you know, we've been doing a series around ASRS and the mandatory reporting requirements. Would you mind describing your role and give us a bit of background with regards to reporting?
Yeah, sure. Nice to see you, Andrea, and thanks. So I'm a partner in our audit and assurance division, and I focus on helping clients around sustainability reporting and climate change reporting. I've helped establish the practice many, many years ago, and really pleased that it's now everywhere, and we're moving from voluntary to mandatory, which really help uplift and drive action as we navigate as a world climate change.
I love that. You've obviously seen all these different scenarios historically around voluntary reporting, but now we've moved into compliance. What I am hearing from some organizations is this tension between compliance and value creation. Would you mind sharing a little bit about what you're hearing and perhaps what could be an opportunity around reporting as it becomes mandatory?
Yeah, no, for sure. And there are elements of compliance in there. It is a standard now. Previously, we had frameworks, which were more about people and companies voluntarily adopting. Now we have standards, which means there are minimum components. But the standard itself is really about creating value, and it's around articulating how an organization is responding to climate change. There are a number of things that the standard says companies must disclose, their emissions, for example, but it doesn't say that they must have an emission target. It's if you have a target, disclose what it is, how you're going about to achieve that, which gives the information to investors. That then allows companies to explain what they are doing. So an investor can then make a more informed decision as it comes to the changing world we're living in, or as the world looks to reduce emissions. So it's really a value creation opportunity to articulate what you're doing to your investors and other providers of capital, which is what the standards are focused on, really around the financial sector to drive change.
So, Paul, we've talked a lot about the value creation of what sustainability reporting can unlock. But what is the financial impacts that also come with sustainability reporting that the finance office should really consider?
That's a really good question. And because the standard is asking organizations to explain the financial impacts, short, medium, and long term. And that is as there is a changing climate, or as we look to continue to reduce emissions, that will mean potentially change in market opportunities. And what could that mean from a financial upside perspective? Similarly, there may be some risk from physical climate change in terms of damage and other aspects in ability to access materials through supply chains. So it's really linking that to your financial forecasting and modeling processes. And most businesses will have a longer term or medium term strategy and model. So it's linking climate into that and seeing, well, this is the potential revenue opportunity, or the revenue risk, or the asset impact. So that's one of the key, uplift areas where finance and sustainability really need to work together, is to really link climate changing world to your financial or potential financial impacts, and sharing that to your investors so they can go, oh yeah, we understand, and we're going to support you in your strategies around being resilient or accessing those opportunities.
So really bringing that finance office and the climate impact into one conversation.
Just so what? And that's really important, because this disclosure will be next to the financial statements in the annual report. So a stakeholder can read it and get the sense of, okay, what is the organization doing? What could it mean go forward? And that's really important. And that's what we haven't had before through voluntary reporting.
So the compliance and mandatory requirements are occurring now.
Yeah.
Some organizations may have started, some may be behind.
Yeah.
Maybe tell us, what is a good pragmatic start for an organization that is about to look down the barrel of the reporting requirements? Maybe they've been doing some voluntary reporting, maybe not.
Yeah.
What is a good, pragmatic, simple way to at least start the process for themselves?
Yeah, the first step is to do a gap assessment against the standard. Review the standard, look at what you're currently disclosing, and also understand your processes. And then you'll see how far you need to do and take some of the...
Can I ask, what is a gap assessment?
Yeah. So it's really looking at the standard. The standard addresses 4 pillars: governance, strategy, risk management, and metrics and targets. So it says, for example, in governance, disclose how the board and the management consider climate change. So look at what you currently do and go, do we articulate climate change? Have we disclosed that appropriately? So there might be an uplift there, there may not be. And what we find is pretty much every organization has stuff that they can leverage. No one is starting at zero. There is something about what you're already doing. A lot of companies are doing voluntary information that is easily leverageable. And then that helps you understand, well, there are uplifts, but it's not huge in many areas. There are some where maybe more than others, and that's part of the gap assessment, and that allows you to build a plan and a roadmap to drive it forward.
So you're obviously talking a lot about data.
Mm.
What are you seeing in organizations around how they're acquiring data throughout their organizations and what they're thinking about when it comes to the future of reporting as it, hands-on every year?
Yeah, and data is really key, and it's both understanding what data you have now. So maybe you already disclosed and account your emissions on scopes 1, 2, and 3. Scope 3 is an area where there may be some of the bigger gaps. So identifying what data you've got now, what data you need, and building out the plan for that. Looking at the systems, many data sets now are in spreadsheets. Thinking over time, we need to move to systems, and so identifying what you've already got in place and how you can move through that over time. It's not about, you can't do it all at once. It's building out a journey, but identifying the data sets that you need, what you've got, how you then go about tightening those up.
So applying a really pragmatic lens, looking at what you've already got, and then looking at a gaps assessment in order to identify any areas that you need to uplift is kind of what I'm hearing from you. Is that right?
That's definitely the stage one.
Yeah.
And then along the way is making sure that you're engaging across the business as you're doing that. This is not finance's job. It's not sustainability's. It's sustainability and finance together with risk and strategy, because to meet the requirements of the standard and to tell your story, you need to bring all those folks along the journey. And so everyone's got a role to play. We are seeing finance take a greater lead because it is now going to form part of the annual reporting suite. But because it is a strategic opportunity to disclose your climate agenda and your strategy, you've got to make sure that it's whole of business and cross-functional endeavor.
So if I'm sitting in the sustainability team, what should I be thinking about to work best with the finance team and vice versa?
I think it's about going to your finance colleagues and saying, this is a standard, how do we do it together? There's insight sustainability colleagues can bring around the nuances around climate change impacts. There's opportunities finance can bring in terms of what does that mean for our numbers? Climate, the world is changing. There are various impacts. We see them now and we're likely to see them in the future. These things will manifest in ability to move goods and services, and that means it's a coming together of mindsets. And that's the exciting piece. So I would say any sustainability colleagues listening, go speak to your finance functions, vice versa, any CFOs, go speak to your head of sustainability and how are we addressing this and how do we capitalize on the opportunity? And that's what it's about.
Awesome. So it's 2025. We're heading into the next fiscal year.
Yeah.
What are the things that companies should be thinking about in either wave 1 or even wave 2?
Yeah. So if you're in group 1, then you should have, I'm expecting, if you haven't done a gap assessment, already do that. You should be working on closing the gaps. So really push through that and bring the business along. We have board directors really interested in this. This is a new area for them where they'll be signing off on director declarations around this information. So making sure you engage your board, engage your senior management, and really start to develop your disclosures early. We have some organizations doing some dry runs. So it's about understanding your process and really getting into the detail. Don't leave it to too late. And then if you're in group 2, again, you've got a little bit more time, but group 2 are likely to be less probably sophisticated in terms of previous work. So there may be additional uplifts needed. So again, it's start early and then build out a plan. Group 2's got a bit more time and therefore they're able to build out that plan with a bit more time to engage.
Thanks, Paul. So what I'm hearing is there's a really pragmatic way that companies can explore this. They can look at data they already have in order to then explore what a gaps assessment can provide around uplifts that are required. They can work with their sustainability and finance team together in order to understand how they unlock that data moving forward. And then how do they really embed that through the organization as they proceed year on year? Thank you so much for being with us today. That's some great insights. I really appreciate your time.
No, you're welcome. No, good to see you. Thanks, Andrea.